Hello, ladies and gentlemen, and all traders. Welcome to the next free live webinar in a series that I will personally be conducting so that our clients can get the best out of their trading experience. Today's webinar will be about money management and trading psychology. I put these two together because a lot of management of your funds based on your CFD trading comes with trading psychology. What is trading psychology and what is money management? We'll look into those shortly and how it's affecting your trading. So just wanted to say thank you for joining me. Welcome once again. And as I said, this is a every Monday free webinar. As we go on to different topics, I will also be covering different topics as we go into these webinars as well. So without further ado, let's go on to the first slide, just to show you what we're going to be looking at the moment. So managing your capital, what does that mean? Well, depending on your trading style, how much should you invest in your trade, if it's daily or weekly or even monthly, quarterly, etc. So I've just done a small calculation here, just so it's a little bit easier, back to basics. And if you have joined me for my other webinars, you will see that we did trading calculations in the last webinar, which was very helpful to a lot of traders that didn't really understand some of the margin requirements or profit and loss figures that we actually move on ourselves. So let's just take a look at just a brief example. So $10,000 balance, how much should you invest? Well, if you've got a 1, 5 or 10% risk management, how will this affect your overall account? So if we do 3% risk, so 3% risk of 10,000 is $300. And then if you put 30 trades into that $300, then you're roughly risking about $10 a trade. So it's quite satisfactory. You're not risking too much of that trade. If we just look on my MT4 demo account for Orbex that I've got, currently got just under $1,700 in it. So if I wanted to risk 3% of that, we'll just get the trusty calculator out. So 1,681, and if we put it into a percentage, sorry about that. So that's 3%. So $50 I want to be risking, and if I then divide that by, let's say, 10 trades that I want to do in a week, maybe, then I'm only risking $5 per trade. So, or just obviously you can see just over $5 per trade. So these are the things that you should keep in mind when we are looking at how much to risk and what is the best value for your CFD trading as well, so you don't get sucked into too many bad trades and you do have a chance of actually moving onwards with these trades as well. So how much should you risk based on your risk management? Is 5% too much? Perhaps is 3% too much? Perhaps that we've just given the example there. So if you're risking 5% on each trade and opening 5 trades at the same time, then 25% of the capital is being at risk, which is 5 times 5, 5% of 5 trades. So it's not uncommon when seeing trading CFDs to see 4 or 5 trades losing at the same time. So if we just go back to my demo account, if we just open some very small trades here, 0.02 in the euro dollar, let's go for dollar yen. If you have any suggestions, let me know. Let's sell that. I've just got a suggestion. Oh, pound yen. Let's just check pound yen. Yep, I can buy or sell. Okay, we're buying that. So let's just buy 0.02. So based on that, I'm just going to wait for the spread to materialize, and then we'll see how we're doing that later in the session. But that's my risk management. It's not uncommon to see maybe 2 of these 3 trades losing, but the most important thing is that you're not risking more than what you want for your balance or free margin. As you can see here, my margin requirement is only $15, which is satisfactory. And obviously, depending on how much I'm risking, I'm losing just under $2, which is pretty much not a lot, since I've got 1,700 almost in my account. So with that being said, this is just something to keep in mind when we're looking at what we want to risk as well. So if we look at the chart, euro dollar, let's pull a Fibonacci retracement here. So this is the last swing high. So let's go from here down to the bottom here. So as you can see here, we're almost at the 61.8% retracement of the Fibonacci level. And the 61.8 represents the golden ratio, which is a very good retracement and turning point. So I'm thinking that if I don't break this 61.8, the market will start moving lower. So I'm going to wait until we might get another push at this level here. And then I'm going to start probably putting a sell position on the euro dollar at least. And then I'll expect it to start moving lower in that regard, based on the Fibonacci retracement levels. But that's my own technical analysis. That's my own risk management as well. If I see that I'm losing a little bit too much, I'm going to expect a downturn and prices will start moving lower, possibly back to these bottoms that we've seen here. And with doing that, I'll be able to see if my risk management is as good as I think it is. So as I said, going back to here, it's not uncommon to see these losing trades. So don't panic. Just make sure you're not risking too much of your risk capital. So as I said, I've got 1,700 almost in my Orbex demo account, and I don't want to risk more than 5%. So the 5% was roughly about $50, was it? So I know that I can have this in a minus 50, but I'll still be content, or even minus 30, minus $40. I'll still be content because my risk management is allowing me, and it's not going to break my account if I lose $50 from my balance. So just something to keep in mind. And this is what I want a lot of traders to understand, because it can be very, very worrying if trades are in a negative, but it doesn't necessarily mean that your account is going to be wiped out or you cannot recover, because you can if your risk management is correct as well. So just take that into account as well. So what things do we look at when we're dealing with risk management? What things do we take into account? Well, avoid trading during high volatile impact news events, as whipsaw effects could badly affect your account. What is a whipsaw effect then? So if we go back to a big news event, if we go back to the minute, let's put it on a minute chart, for example. If we go back to a news event that happened earlier in today's trading, we can see that maybe there's some big candlesticks here. This is quite a big one. It's roughly about 5 pips in 1 minute. So this could be very, very damaging to your account if the market starts going a bit crazy, even more, maybe 10, 20 pips. We've got the non-farm payrolls this Friday. When that news is released, there can be moves of up to 50 pips in a few seconds. So avoid trading these events if you're not used to it, or you don't want to risk too much in your trading. Apply protective stop losses and take profits. Never trade more than you can afford to lose. And how much capital the risk depends on your risk appetite. So looking into those stop loss and take profits, let's go back to the 30-minute chart where it's a little bit clearer to see, especially on the euro dollar chart here. So at the moment, I'm thinking to myself, okay, if the market's, I've got a buy position on the euro dollar. So if the market starts moving lower, how much do I want to risk? Well, I'm happy probably to put a stop loss in roughly at the 38.2. This is a nice level for myself that I'm happy with. So that's 1.0979. So in order to calculate what my profit and loss would be, I simply take the open price of 1.09904, which is what we've got here. And then I'll minus the projected target that I'm thinking. So that's going to be 20.4 pips. So we take the fourth digit after decimal is the pip. And because this is a 0, we move on to the next one. So this is 20 pips. And then 20.4 pips. So 20.4, and then we multiply it by 10 because the euro dollar pip value is $10. And then we multiply it by the lot amount. So $4.08 I will be predicting to lose if I put a stop loss in there. So for me, that's fine because it's not really going to damage my account too much. So based on your risk appetite, we could make it a little bit lower. We could go down to the 23.6. So let's see how that turns out for us. So 1.09994 minus 1.09656, which is the new value at the 23.6 Fibonacci retracement. So now we're going up to 33.8 pips. So 33.8 multiplied by $10 per pip for euro dollar, and then multiplied by the lot amount. So again, $6.76. As you can see, not too detrimental in the fact that we are looking at probably a loss, but not something so crazy. So this is how we can see what our stop loss is going to be, what our take profit is going to be. Maybe I don't want to get too greedy, but depending on my risk I probably just want my take profit to be roughly about a nice psychological figure, maybe 110.50 or 110.40, something like that. The 100% level is back at 110.35. Will I be happy at this level? It depends all on your risk appetite, but it's best not to be too greedy and take those profits when they are viable. So at the moment, I'm still losing, but I'm happy because it's a small amount. I didn't take a big lot size out because I know that if I took a bigger lot size, then these profit and loss figures would be magnified. If this was 2 lots, if this was 3 lots, then this would be a lot bigger price. So as I said, any questions, I'm happy to answer them live. If you have anything that you want to ask about Fibonacci retracements or anything that we go through at the moment. So trading psychology. So emotions and mindset equals the best decision making, or what decision maker we can go for. So what are the main emotions that we go through when we are trading? Well, we've got confidence, discipline, fear, hope, greed, and regret. And we'll look into these more closely, starting with greed. So greed means we're taking on too much risk. We're staying in a trade too long in the hope it will turn around. We're doubling down sometimes on a losing trade and being over leveraged. Now, we'll go into detail in these, but let's just start with taking on too much risk. So if I wanted to open up more of a trade on here, so let's go to 0.80. I'm going to buy as well. So now I've got 0.82 lot sizes. So as you can see here, the margin for the spread is a lot more, and you can see my P&L has got a lot bigger basically because of that. So that might be taking on too much risk. However, I am still only $20 down, $20 out of 1,700. Approximately. So, you know, I'm only risking just over 1% of my account. So again, it's not something too crazy at the moment. I'm very easily happy based on the trades that I've made. However, if I stay in a trade too long, if I'm losing maybe $100, $200, even $500 in the hope that it will turn around, these are when mistakes can happen, because obviously if you are close to your MT4 account being stopped out, then it's not a place we really want to be. I'll just show you that again. So if our margin level is dropping close to 100%, that's when we get our margin call, and then 20% is when our trades start getting closed out because of the lack of funds in the account. But as I said, those of you that are usually watching my webinars, you'll understand how this is all calculated, but I will be going over margin calculations once again next month in April, just to make sure that everyone is clear on the margin, on any calculations when we're trading. So as we go on, double down on a losing trade, meaning like I did just then, perfect example. I didn't double down because it would have been 0.04 lots, but I went more than double. I opened almost 1 lot on euro dollar in the hope that it's going to turn around. As you can see, my loss has actually started getting a lot bigger at the moment. So with that being said, we'll see if anything comes about that as well. So fear, what do we mean by fear? Well, when positions move against traders, this poses a threat to the trading account. Before entering the market, the fear of loss stops the strike position and in turn loses the opportunity. Confidence then diminishes, and coming out of trades too early or going in too late can obviously damage your account as well. But fear can be useful. I wanted to point this out in my last bullet point, because learning from past losses means not moving away from your trading plan in general. So it's all, you know, trading is all about confidence. If I'm confident that this market will keep pushing higher, keep moving higher, then I'm obviously going to put a buy position in, and I'm going to expect the trade to start moving higher. Even if you have suffered some losses, it's always good to have confidence, because once fear starts striking in, then it can be a very lonely place in the trading world. And this can be very, very difficult as well to try and pull back any losses. So best not to have this before entering the market, as you could actually end up losing quite a good strategy and good positions as well. So it can be very, very detrimental on your account as well. So we'll see what happens at the moment. We'll go back to, I want to keep going back to my MT4 account because I want to show you that all these emotions that I've put in at the moment is justified because I'm looking to see what the next trade is. So let me just open this chart window as well for the pound yen. I got asked to open that from one of the people on the live webinar. So we'll see how that goes. So as you can see, it's fallen down the pound yen. So we're expecting possibly another move lower, roughly about these bottoms. However, as you can see here, we've had some support roughly about the 161.29, 161.30 level, and now we're bouncing higher. So it might have been a better idea for me maybe to, I opened a buy position. So we're expecting that to go a bit higher now if we see this bounce being fully incorporated. However, there is the risk that this move will keep pushing lower. So this is a good emotion because I'm confident and I'm hoping that the price will keep going lower in that respect. So this is brings me on to the next emotion or next psychological reaction that we get in the market. So hope and regret. So regret could influence you to enter trades at the wrong time. Hope comes after regret in the sense that the trader will make some sort of profit. Hope is connected to pride as well. Some traders don't like to admit that they're wrong, myself included in the past where I've opened trades. They've actually been sinking quite ridiculously, but I've never admitted that I'm wrong. And what goes up must come down, right? So in that respect, let's go back to the MT4 account and see where we are with everything. So let's see. I mean, you tell me what you see here. You know, we've got a move lower on the pound yen. Let's check the dollar yen as well. So as you can see, it's moving in the same, pretty much the same context as the pound yen as well. So if we look at the pound yen chart, which is here, and the dollar yen, we'll put it on the same time frame so that we can see. So it's pretty much a copy pasted example. As you can see here, we're seeing a bit of a bounce and support where I've opened the trade and I've actually sold it. So I'm hopeful at the moment that the market will start moving lower. And I'm hopefully not going to regret the fact that I opened a buy and a sell on two currencies that involve the yen as a quote currency. So I'm pretty much kind of hedging my position here. I'm selling, I'm buying the yen on this trade and I'm selling the yen on this trade. So in that respect, I'm hopeful that the trade will start moving lower in that regard. So I've just got a live question at the moment. How would you sense that the dollar yen is going to go? Well, at the moment, we have to hope it's a little bit like the pound yen, to be honest. We're looking for a bit of a bounce. I mean, I've opened a sell position and I have to hope that we break this particular line. I'm just zooming a little bit more so it's a bit more easy to see. I'm hoping that we break this particular support line here. I'm saying it's a support line because this latest wick is bouncing off this line and the body of this candle is resting on this line as well. And this could be actually a false break in the market. So it doesn't really give me much of a signal in the last candlestick that dipped down. So with that being said, I'm hopeful, I'm confident, I'm not going to regret at the moment, but if the market starts moving higher, then I will regret. The emotion will come in very quickly. If the market will start swinging higher and we get these particular tops here, then I'll be very, very regretful that the price went higher and I missed it as well. So again, these are all things to take into consideration when we are trading on this psychological level. So let's just go back to the presentation. So like I said, hope is connected to pride. Some traders don't like to admit they're wrong. And in that respect, I'm hopeful. I'm not regretting at the moment opening these trades, but you never know. In the next 30, 40 minutes of this presentation, I'm hopeful that the my trades will go into the right amount of profit for me. So confidence and discipline. So discipline equals consistency. Consistency is equal to more chance of successful trading, and success equals confidence. So the best thing to do as you get into your own portfolio, as you start learning the trading plans of yourself, is trust your own trading plan. Lose the crowd noise. The crowd noise is basically when there are news events, when there are big moves in the market. If you want to wait until this has died down, if there's not so much volatility in the market, then it's better to lose that noise and wait for the, let's say, the normality of the chart. If we look at this particular day so far, so this is the dollar yen trading day, as you can see, the market is pretty flat at the back end of last week. As we come into today's trading, we've seen quite a big spike to the upside and now to the downside. This is very, very choppy. We've pretty much, as you can see here, from the morning session, we've pretty much moved, you know, over 200 pips higher, 30 pips higher. And now we are moving back down again. So the reality is that we might actually have a big swing and prices will start reverting to when the open was today. If you want to avoid this, look at a chart that might be a little bit less choppy. Again, euro dollar can be very volatile because it's quite a big traded amount in the Forex world. If you look on gold today in the last few days, it's been pretty flat, as you can see here, going up to 150, 160. And not really breaking past 120, 110. So that's roughly about a $40 to $50 move for the past couple of weeks, which isn't really that bad. If we look on a daily chart for gold, as you can see here, the big swings in the market, these are to probably be avoided if you're not used to trading these volatile periods. But as I say, at the moment, if you look on from the last few weeks, we are looking at quite a consolidated, flat moving sideways maneuver there. And with this, we are looking like it is actually losing the crowd noise and making sure that you're not really involved in any big volatile moves. Use your initiative and avoid the obvious. You know, if there is a big move in the market, you can trade on it on a reversal or something like that, but use your own initiative and just make sure that the trades that you put into place are going to be the best ones. Don't break your own rules. Don't go against something that you believe in, and don't be afraid to take risks and lose some positions. So going back to our previous slides here, as you can see here, pound yen is working in favor for me. I'm in a profit now. Euro dollar, I'm still waiting, but because the pound yen is moving higher, most probably the dollar yen is going along with it. So because I've sold the dollar yen, I'm most probably going to stay in a minus with that, but we'll see as the evening goes on. As you can see, euro dollar now, I'm in a profit with the the bigger buy position that I put in. Let's go to a 1 minute chart so it's a little bit easier to see. So this was my previous 0.02 trade that I opened. And this is the 0.80 trade that I opened. As you can see, we're just kind of moving above that at the moment, but it's just precariously hovering because now I'm back in a minus. So we'll keep an eye on that as we go through the presentation. So now, as I said, my emotions are telling me that I'm hopeful the market will keep pushing higher. I'm a little bit fearful because I'm kind of thinking, as you can see here, the market is moving lower now on the minute by minute chart, and it's not good, but I'm hopeful, but I am fearful at the same time. I'm not being too greedy at the moment. I don't think a 0.80 trade is too greedy based on my margin, my margin and my balance. However, I'm just looking at the moment at what the best moves are for me. So this is where it all ties in to this trading psychology. As I said, don't be afraid to take risks on some positions as well. It can be very, very beneficial, but yeah, trust your own trading plan and don't try not to break too many of your own rules, as you can get a little bit stuck on where to go next as well. So noise trading, just want to look a little bit more into that, because it can be very, very beneficial as well if we understand exactly what they are. So this is someone that trades based on rumors. We're not trading on facts. So if we think the NFP numbers on Friday are going to be very detrimental for the American economy and the numbers miss heavily the expected figure, then we can already put sell positions in on the dollar currency pairs, because we expect the dollar to go lower because it's going to be more weak. So that's trading the rumor. But trading the fact is when the news results do come out and we see the figures in black and white, and we can then jump on these trades and trade and not trade the rumor anymore. It's also someone that does not take into account the fundamental or technical analysis as well. So, as I said, we'll go back to our euro dollar chart. We've done a little bit of technical analysis on the Fibonacci retracement, thinking that the 61.8 golden ratio is a good period where the market might start swinging back. Even the 38.2 is a good figure. However, as you can see, it's broken through the 38.2, broken clearly through the 50, but now you see there is some resistance at the 61.8 almost. But with that being said, we are looking now at possibly looking at our technical analysis, and we'll see what the fundamentals are as well as we go into the next trading session. But a noise trader does not take into account this. They'll probably just look and think, okay, the market's moved up. Let's see, market's moved up roughly about 50 pips. I'm expecting a reversal. And they won't. This is how some people trade, which is fine if it works out. But without noise traders, the market could be more effective and expressive as well. And the most important element of noise trading is volatility. So with a volatile market, if there is volatility in the market, then this helps noise traders because they can jump on these potential opportunities as well. And the greater the volatility, the more it will attract noise traders as well. So as you can see here, this move, as I said, to the upside, 50 pips, it could attract a lot of traders looking to jump on these opportunities, because it could have reached as far as it's going to go. As you can see here, there's a nice double top that's formed in the market. I'll just zoom in so it's a better clarification there. I'll just get rid of this Fibonacci retracement so it's a little bit easier to see. So you can see here, between the two buy positions I opened, roughly about the 109.98, we're looking now at a bit of a resistance. You could probably say it's about 110. Let's just put 110 in so it's a bit easier to see. It's a nice round psychological area. So psychological zones are always good to trade on and always good to note, because if it does break the 110, the chances are it will probably keep pushing higher to the next level, which is roughly where we saw these next downturn. But the 110 level or just underneath seems like a very good resistance. And as I said, if it breaks through that, then we are looking at another move to the upside. But what are the risks with doing this? So when there is short-term or emotional investors over buy or oversell an instrument. So what does this mean? I'll just put you back to the presentation. So when there's an overbuy and oversold instrument, this means that there could be a false break in the market and a spike, which I'll probably be able to find good examples. So like here, for example. So I'll just zoom back in so it's a bit easier to see. So we've seen this move here on this double top. So there has been quite a big bullish candle here. It's moved 25 pips in the space of 30 minutes, but we've also got this extra spike on the top here of another 10 pips. But it looks like there's been a rush of blood to the head of a lot of traders. They've bought this particular area and they've kept pushing, but there haven't been enough buyers in the market to keep that full body from emerging to the top of the candle here. So with that being said, as you can see, it looks like there has been an overbuy of the instrument. And then in doing so, prices can leave a false spike. And this can actually drive past levels where they should normally be. So this level here should have probably ended roughly about here, because as you can see, the next candle starts straight away, starts dropping. The next one is quite a big doji there. And again, is pretty much at the top border of this full-bodied candle here. And then after that, we see a spike, a drop down. And as you can see, prices then fail to penetrate to the upside, and then we see quite a big sell-off. So this is a very good example of the risks of noise trading, or just buyers being in them or sellers being in the market, trying to push prices where they shouldn't be. And as I said, the last point here is it leads to false breaks in the market. And false breaks, as you can see here, a perfect example is when there is quite a long wick on the candle, which leads to another move to the upside as well. But you can see these false breaks pretty much everywhere. As you can see here, pretty much like the euro dollar. I'll just zoom in so you can see better clarification. We've seen a full body candle, no wick on the bottom. So it means that there is a really big push in the market, but then prices have exceeded where they should be. And most probably the price should have stopped here, because the next, guess what? The next candle starts, opens at that area and then starts falling lower. The next candle fails to achieve these fresh highs, leaving another false break. And then we see this pressure and this sell-off on the pound dollar pair. So another very good example of a false break, and when short-term or emotional investors overbuy or oversell an instrument, because it's very, very clear. I want you as a trader to understand how we can see these moves in the market. So we've had a big bullish turn in this particular candle. It's on the 30-minute chart. We've had a false spike because we haven't had enough buyers to accommodate this push. And then the next few candles, this one has really turned around and moved lower. The next candle has failed to start pushing higher where the last candle was. And then we've had this dramatic sell-off. So we're just looking now. I'm just getting a live question, 1 second. Okay, the live question is how to know when it's a false spike in general. Well, I mean, when you're trading, if this was blacked out now and we only had this particular candle and this false break, the likelihood is that the next candle will start moving lower. But the best thing to do is when the next candle comes out, you can see that the candle is going lower. And then this is a good indication, as I said, that once this candle is finished, check the next candle. And if it doesn't have the same momentum, then this sell-off here would have been very, very easy to spot. So a very, very good move in the market. And depending on what lot amount you opened, there's roughly about a 60 to 70 pip drop in prices there. So let's check that, 70 pips multiplied by let's say 0.5 lots, and then multiply that by $10, which is the pip amount. So $350 could have been made in that downswing there. And that was quite easy to spot. Going back to euro dollar, as I said, same kind of thing with this particular sell-off here. We've had a couple of tries to get back above. And as you can see, once it's been rejected, then the likelihood is that we will start selling off. And this is only short term. I'm not talking about a long-term move, but as you can see here, another move, 40 pips, again, times $10, which is 400. And then multiply that by whatever lot size you opened at the time. So these are things that I wanted to point out. But there are advantages to this. And what are they? Well, prices are likely to settle back to their origins, and retracements are usually common, so the market becomes slightly predictable. So with that being said, as you can see here, after this sell-off, prices trade back to their origins. So once we got a signal or an indication that the market was on the upturn, then a buy position could have been entered roughly about this area, about the mid 109, 109.60, 109.70 area. And then obviously we saw the full retracement, which is another about 30 pips. So these are the things to understand when you are trading. At the moment, this hasn't happened. We haven't really traded back to our origins yet, but as you can see here, we are moving a little bit higher. So if we look at the technical side of it, if we get past a few levels, roughly about here and here, and more importantly here, 1.3160 approximately, then we could expect a full retracement back up to where we saw this previous move to the downside. So just take a look at that kind of thing when you're looking at your technicals as well. And as I said, any questions you want to fire at me, please do so as we're on the live webinar. Always happy to answer any questions. So let's just take a look at my trades now. So I am now starting to regret a little bit opening this larger lot size on the euro dollar. My trading psychology is starting to kick in. I'm regretting quite a lot now because it seems to be moving in the wrong direction for me. As you can see, this candlestick to the downside is not what I wanted to see because I've got a buy position in. However, I am hopeful. I did get a little bit greedy now, I have to admit, and I am hopeful that the price will start turning higher in that event. So we'll wait and see what happens into the next few minutes as we come to the final stages of the webinar. As I said, any questions you want to direct at me, please do so. And I'll be able to get them back at you as soon as possible live on the chat. So now I'm really regretting opening that trade. As you can see here, $60 down. I'm $64, $65. But again, let's just 1681. As I said, I want to risk roughly about 5% on these trades tonight. So $84 is what the maximum I really want to start risking. So if I start losing more than, let's say, $85, which is 5% of my account, I'm going to have to probably close my biggest loss trade, which is this one, and hope that these other trades will start swinging into my favor. But I'm happy to take the loss because it's only 5% of my account, and I'm happy knowing that it's not going to be too detrimental on my account. I'm going to have just over $1,600 left on my trading account, so I'll be okay with that. So it's, as I said, it can be very, very precarious. However, it is actually good for your trading strategy as well. As I said, there are advantages in making some losses as well. So how to develop and improve your trading psychology. So best not to go into a trade without being fully committed and getting in the right mindset. Make sure you are knowledgeable before entering. Remind yourself that it's not a demo account, but a real account, and practice, practice, practice. So when I was starting up trading, I would practice a lot. I would make sure that when I'm opening and closing trades, if I'm hedging, if I'm going in the same direction as a trade or many trades. So let's say I'm buying euro dollar, buying pound dollar, selling dollar yen, it means that I'm buying the dollar on all these trades like I am now, basically. So I'm buying, no, I'm not, I'm selling the dollar here and buying the dollar here. So if there are trades going that I want to go in the same direction, I make sure that I'm knowledgeable. I make sure that I'm not entering a trade without knowing what I'm doing. You know, before I came on air, I just looked at briefly looked on some of the charts here. I said dollar yen, found some good support. Possibly it's going to go higher. However, if it cracks this particular line, I'm going to start moving lower. Same with the euro dollar. Found this double top here, very nice resistance. But I'm expecting, hoping, and I'm confident that the prices will start moving higher as well. So it's all about getting in the right mindset, making sure that you are knowledgeable and obviously confident as well. You could say successful trading has a few good ingredients, you know, psychology, reading the market, money management, like we've just been through, and a good trading plan. You don't have to be a trading psychologist to become a good trader. All you need to do is have your confidence, making sure that you're entering and exit the trade at the right time, which is quite important, and making sure that you are looking very, very well at your trades as well. So learn that each trade obviously is independent. Even though you might have be selling and buying the dollar or the yen like I'm doing at the same time, know that each trade here, I'm losing 48 on here, I'm gaining 64 cents here, I'm losing $2.46 on here, I'm losing $1.48 on here. These are all independent trades, so just make sure that it's not really something you want to put in together, and know about your risk management as well. So as I said before, I was looking to see how much I'm risking. I'm risking enough at the moment to make sure that I'm happy with my trade. It's not going to be too detrimental, and I'll be able to sleep tonight if I only lose roughly about $85, and we'll see what happens then. So as we come to the end of the presentation, I've just got a few questions that have been asked at the moment. So I've got one trader that wants me to open a trade on gold. So let's have a look then on this. So at the moment, we're seeing a bit of a retracement to the upside. So the last swing high was up here. So let's get the Fibonacci out, roughly put it here to last low. So coming up to the 50% that we've had some resistance, and now we've gone down. We're consolidating between the 23.6 and the 38.2. Where do we think it's going to go next? What should we open? Should we open a buy or a sell? Okay, I've been told to open a buy from one of our traders. Okay, so let's go to the gold. I will open, let's say 0.30. So we agreed a buy, right? Okay, so it's a buy. So we put that buy in. So now we're fully confident that the trade will start moving higher at some point. But with that being said, as you can see here, I've got 5 trades open now, and 4 of them are losing. So should I be worried? Well, I am fearful that I will hit my 5%. So now, do I increase my risk appetite to, let's say, 8%? If we go as it is, 1681 times 0.08. So if I creep up to 8%, I'll be losing $134. So 134 minus 1681. So my new balance would be 1,546 approximately. So I would have lost just over 100, well, yeah, the $135. Would I be okay with that? Yes, I probably would be. So then I can put in correct stop losses while I'm on line and I'm looking at my MT4 account. I can put in good stop losses and take profits because of that as well. So you could say for the 5 trades I have open, I'm not so greedy. I'm not looking to, let's go back to the emotions and mindset. So my greed hasn't really overcome me yet. I've got 5 trades open, but they're quite small trades as well. I'm hopeful that the trades will turn around, but I am a little bit fearful and regretful at the moment because, as you can see here, these 2 trades at the moment are not doing very well whatsoever. So I'll keep them open for a little bit longer as I go on to this presentation. So as I said, any further questions, let me know, and we'll be able to see what's happening at the moment. So we'll be able to see what's happening in the near term as well. So at the moment, we are looking a little bit precarious on this gold trade. And it's probably for the best that I open very small positions on the euro dollar and dollar yen because they have really fallen out of favor for me. So now I'm getting a little bit regretful that these trades are open, and I'm also worried that the trade will start moving to the downside as well. And just one more question that I've just been asked as well. So how many trades are too many trades? So when is it that there are too many trades open? Well, this, again, it's all about your risk management, your trading psychology, your trading philosophy as well. When do you stop opening trades? Well, obviously this terminal can keep going quite a few times down, can actually put it up higher. And obviously, you've got a lot of room to open some more trades. However, getting back to the question, in all seriousness, it all depends. As I said, I'm currently losing $110 approximately, which is roughly about 6 or 7% of my account. I put it up to 8%. I don't want to go any more than 8. I could go up to 10%, which is going to be obviously $168, depending on my balance. but I don't really want to go any further than that. So based on that, we are now looking to see what the best return is for my risk management and my own psychology. I'm not going to get too upset about it, even if I do lose, because as I said before, it's not uncommon to see 4 or 5 trades being in a loss at the same time. It can be very, very detrimental and advancing. So we'll see how that goes as well as we go into the last few minutes of the presentation. So as I said, I'm going to stay online for a few minutes, no, roughly about 20 minutes, 30 minutes. So any other questions that you'd like to let me know, please ask, and I'll be able to get back to you as soon as possible. So please don't forget that I'll be starting my next round of webinars. This will be an introduction to CFDs and the basics. Then we'll be looking at money management and so on and so on. Also, we'll be looking at the beginner's guide to Elliott waves and trading with harmonics as well in the next month on the webinar. So feel free to come back to me with any of your requests for the webinars, and I'll be able to see what's going on there. So once again, thank you very much for joining me on this webinar, and we'll speak again next time.